brain trust of JP Morgan. Kalpana, Morparia, Brijen, Puri, Sajjid, Chinoy and Bharat, Iyer are all with us, representing the entire gamut. Of course, Kalpana represents everything, and Brijen for fixed income, Sajjid, the economist, and Bharat Iyer, the head of equities, to tell us, give us a 360-degree perspective of the economy. Well, morning first, Kalpana. The big elephant in the room is demonetization. You can see it from the angle of banks, you can see it from the angle of how FIIs are approaching, how steady can the rupee get. What's your short comment? Is there a long-term gain?
I genuinely believe so, because every such step change has involved a lot of change. I mean, just look at the journey of India. We all root the fact that India did not have mainframe computers. We are also thankful we didn't have mainframe computers. We all root the fact that India had very few fixed telephony. We are also happy we didn't have enough, so that you saw the migration into 1 billion mobile phones. And now I think the new thing is digital cash. I know people are saying, is that an afterthought? To my mind, that is the prime driver. India was a complete outlier in 11.5% cash to GDP ratio. We were outliers even amongst the other emerging markets. And I see a lot of anecdotal evidence, certainly in urban India, on how swiftly habits are changing.
Okay. Well, let's take that question up with Sajjid as well. Sajjid, good morning. We were just speaking to Temur Beg a while ago, and he said that it's very, very difficult to assess what the impact of growth will be because of demonetization. In the recent past, we've seen things get exacerbated a bit, on the worsening side. What's your own analysis?
I think there are a couple of things here. There will be some near-term growth hit for a couple of quarters. We can't ignore that. But to quantify that is much harder, because the data is all over the place. Yes, we had weak PMIs in November, but equally we had very strong import growth yesterday. So our own sense is you probably get a 50 basis point reduction in growth for the full year, about a percentage point less over the next 2 quarters. But I think that's not the key point. The key point is we all worried about a more enduring negative wealth shock the morning after demonetization. And with all these deposits coming back in, there are 2 or 3 very positive implications. One is that wealth shock, the primary wealth shock, will be much less. And secondly, to go back to Kalpana's point, if we find a year from now that India's tax to GDP ratio is just higher by 0.5%, because these deposits have come in, you brought some money into the formal economy, they're being taxed on a recurring basis, and you get 0.5% of GDP in higher tax revenues over the next 5 to 7 years, that will more than pay for any near-term 2-quarter growth shock. So I think that's positive. And the final point is the government is more confident now that by December or January, 60 or 70% of this cash will be remonetized. I think that's more important. If this is a 2-quarter story, I will worry much less about the enduring growth impact vis-a-vis a 4-quarter story.
Well, Sajjid, I wish I could be as optimistic. The brazenness with which, I don't know whether it's 4 lakh crore or 5 lakh crore or 3 lakh crore of untaxed paid money has working its way into the banking system. It can surely work its way back as well, is my big fear. But I hope I'm proved wrong. But I want to ask Bharat, which is the bigger elephant for an Indian equity investor? Are we worrying too much about demonetization? Are we really dancing only to the global theme, which is, Fed dollar at 103, the dollar index, US yields at 2.6 now?
I think it's a combination of factors. I think what's happening in the US, particularly in terms of the rate cycle and the trajectory there, is very important for valuations. Because let's face it, most asset classes in the world have been trading at a premium to long-term average for the last 5 or 6 years, and that's been basically because of easy money. Where demonetization plays through is in terms of the near-term growth implications that Sajjid mentioned, which is the reason I think, overall, if you see the performance of the equity markets since demonetization was announced, it's been fairly mature. I mean, there's been no knee-jerk reaction, there's been no panic over growth, decelerating over a quarter or 2. So I guess, it's a combination of factors, and we will have to, contend with lower valuations for the market at some point in time, which has got nothing to do with what's happening in India. Growth, I think investors are willing to look through the slowdown. I mean, we've been interacting with a lot of investors over the last month or so, and most of them believe, yes, it's going to be a 2-quarter phenomena, but they're willing to look through it.
So what is your expectation from the budget this time? Because there's a lot of talk about some pre-budget SOPs, something like a farm loan waiver, etc. What is your own expectation this time?
Well, I guess, broadly, as far as the equity markets are concerned, the expectation is that policy will be fairly accommodative over the first quarter of 2017. And I guess, as far as the budget is concerned, yes, there are expectations that there will be increased spending in priority infrastructure areas, and that will be backed up with some kind of monetary easing. And I guess what will also help is, this whole liquidity deluge that's come into the banking system means transmission is going to be much better.
Correct.
Yes, I know you're excited, Kalpana, but let me get one more word on bonds before I ask you about the banks. Where is fixed income headed? Especially, 10-year and separately the CPs. We saw 611 and then 650 now, 660. So is the best over for bonds?
So I think the market was really pricing in a few things based on their expectation of the impact of demonetization. Some of that has actually not necessarily played out. And second, the RBI MPC has really chosen to look through the immediate impact and wanting to wait through the actual numbers, probably more prudently. Hence, while the market was expecting 25 to 50 basis points in December, with an additional 25 basis points in March, now we are left with just the potential 25 basis points in March, given that we are over the sweet spot from an inflation perspective, and we have the uncertainties, like you mentioned, the budget, as well as global events, Brexit, Greece, French elections, etc., all of that put together. In that context, for the short term, we've probably seen the short-term lows, because if your repo rate in the next 6 months is going to be at 6%, around between 640, 6.5 is something which is close to a fair valuation, and therefore, with expectations of rate cut and liquidity, etc., can we overshoot maybe somewhere between 6 quarters, 6.5? Yes. In the immediate term, what we are also seeing is there were a lot of positions built up in anticipation of the rate cut. You're probably seeing some unwind of that. In the short term, can we see another 10 basis points or so of an overshoot on the top side like we saw on the downside? Potentially. But we should probably settle somewhere around the 640, 6.5 range.
Okay, so not too much money to be made in fixed income. Equity valuations are going to fall, or at least will not rise. It's looking a bit jittery. We'll do one thing. We'll take a break. We are going to come back. We have been hosting the JP Morgan Brain Trust for the past segment since 10 a.m. And we have Kalpana Morparia, Bharat Iyer, Brijen Puri, and Sajjid Chinoy in the studios with us. Well, Bharat, let's get to talking more micro in terms of sectors. If you have this recovery in the United States, which is expected probably because of Trump's spending, as also because we've seen a metal recovery or a commodity recovery, what kind of stock selection in India?
See, I guess, if you're looking at stock selection in India, specific to the question you asked, yes. We as a house are predicting that global growth this year will be about 25 to 30 basis points higher for next year than as compared to 2016. And I guess, if you look at the entire resources complex and IT services, both of them look very interesting. They are under-owned, valuations are very cheap, and if this growth is going to pan out, then I think they're going to do very well. So I think we would definitely be overweight these areas in the context of an India portfolio.
Okay, even without a rupee depreciation.
I guess if rupee depreciation comes, that will be jam on bread, or icing on the cake. Yes.
So since we are talking about global growth, the theme of this year has been developed markets over emerging markets. You see that the dynamic change in 2017, or will it be the same? Not necessarily.
See, I think it could continue for the early part of 2017. Again, as a house, we are at this point in time overweight developed markets as compared to emerging markets. Okay. But that said, you can't write off the structural appeal of emerging markets. If you were to take a 3-year view, emerging markets are obviously going to do better. So I guess it's tactically we are overweight DM as compared to EM at this point in time. But yes, EM structurally remains still very, very positive.
Okay. Well, let me come to the big, again, elephant in the room. That's becoming a cliche. The financials. Before I get to valuations and stuff like that, Kalpana, your heart may bleed that the financial sector is getting one problem after the other. It was the NPA issue. First, the global slowdown, actually, and then the asset quality review of the Reserve Bank. They seem to be emerging from that. Now, they've been tasked with demonetization. How long before they recover? They seem to have a problem in the asset side and the liability side now.
So liability side, as you know now, there's a problem of plenty. Unfortunately, that 100% CRR has gone off. So I think banks are going to be huge beneficiaries there. They had a fantastic rally on the bond market side as well. And I think actually they're doing a yeoman service in terms of coping with this huge logistics challenge of currency movement and managing an emotionally charged customer base. I know of several branches where people have been working 15 hours a day. Of course, there are bad apples, and we should come down very, very strongly on the bad apples. And banks, I think, are self-reporting a lot of this and are doing that utmost in terms of strengthening the controls in this thing. Net, with the entire move that's happening on digitization and greater faith in the banking channels, I think banks are going to come out really positive out of this.
Okay. So how would you sift in equities? Is this, there was the big NBFC rally. Is there some of it left? Or within the banking space itself, how would you make your choice?
See, Lata, as far as NBFCs is concerned, I think, the markets, some sections of the market are painting the entire, segment with the same brush, and I don't think that's appropriate. I mean, you'll have to look at different segments. If you look at the housing finance segment, for example, we are very bullish on that segment. Courtesy, the withdrawal of high currency notes, you're going to probably see property prices correct a bit. You're going to see a huge surge in liquidity. You're probably going to see 1 to 2 rate cuts. Affordability levels are getting much better. So we would be very positive on the housing finance segment, for example. On the other end of the spectrum, I mean, you have some, companies, who actually, their virtue has been their ability to handle large amounts of cash. In that case, structurally the business model is going to be a little suspect, or they need to start reinventing themselves for the new reality. So in their case, I mean, they may not fare as well. So one has to take a nuanced approach out there. But broadly, I think as far as financials are concerned, particularly those who are using this opportunity, one, to increase their liability franchise, and two, who can cope with the change in technology, I think they should do well. And broadly, all of us will agree here that improving liquidity is good for financials.
Okay, I want to take the point that Kalpana was making about how the banks are trying their best to smoothen out the demonetization process. In that, what is your anecdotal evidence suggesting about how the rural economy has improved or deteriorated? Because no one knows how deep the gashes are over there.
That's right. And I think that's the one part of the economy which is least covered in terms of high frequency data. I think the couple of anecdotal pieces here are that the high value notes are disproportionately low in the rural economy, and relationships are stronger. So therefore it matters crucially whether this is a 6-week phenomena or a 12-week phenomena. If by January, as the government said yesterday, you can remonetize to the extent of 60 or 70%, I would worry much less about the rural economy, because I think relationships and credit linkages can take you through to January. If it's much beyond that, then I would begin to worry a little bit. But I think the key here is going to be that if by March of next year, you've got sufficient remonetization, number one, and you've got the wealth effect being minimal, number two. I don't want to mitigate or minimize the fact that there will be challenges, but compared to what all of us thought 3 weeks ago, that this could take 10 months and there could be a huge negative wealth effect, those risks have come down materially. So I think if you remonetize by March, the wealth effect is minimal and tax GDP goes up. That 0.4, 0.5% increase in taxes on deposits that have come in of 14 trillion is not a very large ratio. So I will not be surprised if in March, in the budget in February, the government is able to increase spending without necessarily increasing the fiscal deficit. Because the one thing you don't want to do in the next year, which will be tough for all emerging markets, is for India to lose its unique selling point, which is macro stability.
Time permitting, I'll come back to the fiscal arithmetic. We have to take a break, but we have more questions for all of you. Back in a jiffy.
CNBC TV 18, celebrating 17 years of business leadership.
Time to chat with the JP Morgan team. Bharat, I was just going through your strategy note, and you have a 2017 Nifty target of 9,600, 2017 end. So that's a big upside from here. Where do you think the leaders could emerge from?
See, I think, we believe that valuations are largely going to remain stable because, the easy bit on valuations is done. I mean, global monetary easing is done. If anything, on the margin, it's going to start tightening. The legislative window for reforms largely seems to be done. A lot has been proposed and passed by Parliament, and now we are waiting for execution. So the heavy lifting here onwards will have to be done by earnings. And the reason we are positive on earnings for next year is, first and foremost, we believe that, as we mentioned earlier, the shock due to, the withdrawal of high currency notes is going to be temporary for the next 2 quarters. And after that, as Sajjid rightly mentioned, if the economy is reliquefied at an adequate pace, we see the local economy bouncing back very meaningfully, and with that, earnings for the local sectors in 2017, at FY18. Secondly, I think, earnings have been dragged down meaningfully over the last 3-4 years by the global cyclicals. I mean, the trend has been very weak, and we think that there's going to be upside there as well.
So when you talk about local sectors, you mean paints, autos, cement? Are you referring to those
I
sectors?
think, any sector, I think most sectors, the domestic cyclicals should start picking up. Banks will benefit because of easy liquidity. Secondly, the call we are making is that government spending in key priority infrastructure areas will go up meaningfully. Areas like highways, railways, rural infrastructure and housing, power transmission. So I think anything that caters to these segments, cement, commercial vehicles, tractors, construction equipment, all of these sectors should do very well.
Okay. Kalpana, are you glad that you're not heading a bank at this juncture in the, in the PSU space or the private Indian banking space?
But there are a lot of opportunities as well. I think banks are probably the most uniquely positioned in terms of taking advantage of this digitization move. I know some of the fintech guys are going to challenge me on this, but I think the rich data that the banks have on their customer base, that they decide they have a distinct advantage over any other fintech player.
Okay. I must tell you, Sonia, in 2003, we had Sir Kalpana in the studio because that year, ICICI's cards, credit cards and debit cards had surpassed Citi and Stancy. Okay. Through the 90s, Citi and Stancy were ruling. And at that time, she said, we are working at a disadvantage. Credit card payments in India are taxed. In Korea, they get a discount. Now the government has heard her, so hopefully, 13 years to
We always get it right.
Is there any money to be made in fixed income, in any part of fixed income, or would you say investors are better off in equities for the next 12 months?
Well, Bharat will talk about the equities part, but I think on the fixed income part, we've seen a large part of the rally. Some of that is also evident in the FI flows. So we've seen some of the FIs pull out. That's been on account of 2 reasons. One is, of course, the US Fed increasing rates and therefore the rate differential story. Second is the fact that they've been looking at the long-term structural story in India. If we are going to have a long-term inflation at 4%, real rate of 1.5%, give another 50-70 basis points for a premium on the 10-year treasury. In the rally that we saw, they already saw that exit. So really going forward, it's going to be relatively stable. I don't see a sell-off because the inflation, as we saw in the recent print also, there is an impact of disinflation, and which will lead to probably another rate cut, and therefore we probably remain stable without too much to do. 2
numbers. How many cuts in this cycle, and where is the rupee 12 months down the line?
So I think the first one is an absolute one. I think 1 to 2 cuts, depending where oil and where the US Fed is. So I think 1 cut perhaps by in February. The second cut will be contingent on global financial conditions and oil. As far as the rupee is concerned, there is no absolute number, and we should get over this obsession of the rupee at a new low.
No, of course.
Central banks think of the currency as a relative measure, right? And if you look at India's nominal effective exchange rate, what the RBI has done very well is to ensure that's been broadly stable. So I think it's a function of how other emerging market currencies move. If EM is under pressure and other EMs move, particularly the CNY in China, I think you will see calibrated depreciation. The only thing I will say is, in a world where EMs are under pressure, that's where India's macros tend to shine more and we tend to outperform.
Okay, are you sure of the 1 cut? Because everyone got it wrong the last time, and too many surprises this year.
And to be fair to the RBI, there's so much macro uncertainty. Nobody can put their hand on their heart and say, here's the growth number, here's the inflation number. So I think they've done the prudent thing. As the data prints, I think the RBI will recognize whether there's space or not. We had a big downside surprise to CPI. Our own sense is first quarter average is about 4.5%. If oil's at 55, that should give the RBI space for 1 cut, I think.
Completely out of time. Bharat, you get only one word. Large caps, mid caps?
Large caps.
All right. On that note, thank you very much, Team JP Morgan, for lighting up our shows and for giving us the benefit of all your thinking. Thank you very much.